Hi, so today I'm going to look at over 25 different insurance companies all in one video. I've never tried this before, so hopefully this goes okay. So this is going to be a lot of analysis, and if you haven't watched my part 1 and part 2 videos on the insurance industry, well, I highly recommend going back and watching those because that'll make what I'm going through today a little bit easier for you to understand. And at the end of this video, I'm going to give you my opinion on the American insurance industry as a whole, so stay tuned for that. So like I just said, I've got a lot of companies to get through today. So this is going to be more of a taste of the US insurance market rather than a deep dive into each individual company. And I think it'll be cool to show you how I find a company before I go into the deep analysis. And for all the companies today, well, all I did was I just did a Google search of the major insurance companies in America and put together a list, and that's it. So there is definitely nothing fancy about how I start my research. Now, before I jump into all of these companies, let me quickly talk about the negatives of the insurance industry. So the first major negative of the insurance industry is there are literally hundreds of insurance companies, and moving between life insurance and car insurance isn't a big jump for a lot of these companies. Also, moving into new countries also is on the radar of a lot of these companies as well. So there generally aren't really any major differentiators between the companies for the consumer. Now what all this means is all these companies are competing on price. Great for the consumer, not great for the companies. And the second negative is that the low interest rate environment, well, it's not good for insurance companies. When the Federal Reserve lowers the interest rates, well, the money that the insurance companies make in their investments now goes down, something that is out of the control of the insurance companies. So generally, they are all affected. Right now, interest rates, well, they are super low, and it might be like this for a long time. It's too hard to predict the future with interest rates, but historically, the average is supposed to be about 4.5%. And as you can see on this graph, we're nowhere near 4.5%. But there is a big reason why so many companies exist in the insurance game. Well, it's because there is a lot of money to be made. Now, here are the major reasons it is a great industry to make money. And the first is that insurance companies separate themselves from others with their ability to use their assets under management to make more money, because they receive money up front, but they pay it out later. So all of this money comes in every year with the insurance premiums, and then the management have the opportunity to invest that money and get a big return before having to pay it out as claims to the customers. And the second positive, well, is the industry expected growth rate. Let me explain. See, over 70% of Americans don't actually have adequate insurance, and the experts are predicting a nearly 100% growth in the industry over the next 5 years. That is a lot of opportunity, and I'm very bullish on the industry as a whole. I actually think it's one of my favorite industries. Now, life insurance actually makes up about half of the insurance market, and the other half is property and casualty insurance. And when I'm looking at insurance companies, what I'm looking for are these things. I'll look at the debt of the company, their growth, the return on equity, their price to tangible book value, and then what I think a fair price is. Now, I'll go through why I look at these metrics in part 1 of the insurance industry videos that I've been putting out recently. So firstly, I'm going to go through Prudential, and then you can just pause the video to actually go through the entire table yourself. Okay, so for Prudential, what I looked at was the debt to equity ratio, and I want to see this under a 0.7. Under a 0.7 tells me that the company is going to be okay if they have any troubles in the future. They'll be able to handle the repayments of their debt. Now, in the current growth column, what I've done is I've looked at the earnings per share and the free cash flow, and I've wanted to make sure they're growing. The expected growth is actually just what the analysts are predicting the average growth rate will be over the next 5 years. And now the next column is the market share year-on-year performance. So Prudential is at 7.7% of the market, of the life insurance market, and that's down 0.1%. That's not much of a move. Now, the return on equity is a little bit important here because as you can see, a lot of these are going to be zeros. Now, it's actually because of the current crisis rather than what they normally do as a return on equity. So I actually think this 0% isn't actually a true reflection of how the company has been performing in the past. Now we're going to look at some of the valuation metrics, and a big one for insurance companies is price to tangible book value. Now, a number under 1 here is quite a strong number. So to see 0.42, well, that means you're buying the company's assets at about half price. And as you can see in the next column, well, normally it sits at nearly 1, about, well, 0.94 to be exact. So this clearly shows that it is a bargain compared to where it should be. And the second last column, which is the buy price, now that's my intrinsic value calculation of the company based on its free cash flow. Now, this is really high for Prudential at $230 a share. That's what I actually think the company is worth based on its free cash flow. And that's not a mistake. The current price is $69 right now. Now, if you look down this table at all of the different life insurance companies, you can see Metlife, we've got Principal Financial, you've got Unum, AEL, and MFC of Canada. Well, they're all at significant discounts to what I think their intrinsic value is, and some of their price to tangible book value numbers are also extremely low. So after doing this little bit of research, I'm extremely interested in Prudential, Principal Financial, Unum, AEL, and MFC. Now this is just initial research. I am very excited, but I do want to do a little bit more and just make sure that I feel like the company is going to be able to maintain their growth rates. And because they're an insurance company that has to invest their money, well, I want to see what their investments are in. But I like Prudential the most at the moment because from what I can see, they're a long way away from any sort of fair value. Now, as a bonus, and I normally don't get too excited about dividends, but a lot of these companies are paying a dividend yield somewhere between 5 and 6%. So that's a pretty significant dividend to go along with the price appreciation potential. So just to put these values into perspective, well, the life insurance market generally sits at around about 1.15 price to tangible book value. So it is very exceptional to see any company in the life insurance space under a 0.5 price to tangible book value. And I have looked at a lot of sectors in the past, and at the moment, I think the life insurance sector is probably the most undervalued I can see across the entire market. So again, after a little bit more research that I want to do, I think picking up some of these companies at the prices that they're at now is going to be a really good move. Now, as you can see, I've put a lot of effort into this video today, so if you wouldn't mind hitting that like button for me, I'd appreciate that a lot, and it won't feel like I've just done all this for nothing. Okay, now let's go take a look at the health insurance market. So I actually like a lot of these companies. UNH and Anthem financially are what I want to see, but the share price is too high for me. CVS, well, that doesn't have the growth prospects of the others. Humana, well, hasn't been recently performing as good as the others either. Cigna, well, I think this is actually the one that I would buy here. The return on equity isn't as good as UNH, but the price is far better. And as you can probably notice, there's a big difference between the valuations of the health insurance companies at the moment and then the life insurance companies. Just look at the column with price to book value. As you can see, well, you've got CVS and Cigna down close to 1, but nothing under 1. And the buy prices that I have compared to the current share prices, again, they're not really in the same range as the life insurance companies. So the life insurance companies that we looked at earlier, they're just so beaten down compared to even just the health insurance companies. So let's go have a look at the property and casualty insurance market. So Berkshire Hathaway is obviously good at using their money for investing. They have been the best managers in the business with Warren Buffett and Charlie Munger. Hence the 20% future growth rate. Now, they have been able to do this for over 50 years now, so they are still probably my favorite company to invest in. Now, all these companies are actually pretty solid financially, and I think the best deals at the moment are probably Allstate, Travelers, and Hartford. So normally I'd get really excited about some of these companies that I've just found in the property and casualty insurance space. The current share prices are far below the buy prices that I would want, including a margin of safety. But I'm still just blown away by some of those life insurance companies about how big of a discount they are to their intrinsic value. Now, I just wanted to throw this one in as well. This is Reinsurance Group of America, and it's a solid company. It's growing steadily along, it's very stable because they do reinsurance. They produce plenty of free cash flow as well, and they're at a very attractive price from a price to book value and an intrinsic value perspective as well. Now, this company definitely warrants a lot more research. They are making a lot of money and the share price is not reflecting that. Now, all of these tables that I've put together today are actually about the current situation. So I definitely expect over the next, say, 5 years that the dynamics inside of the industry are going to change. So think of this video like a snapshot. It's not going to show us the future and it's not really showing us the past. It's just showing us what's going on right now. And all I really wanted to do was highlight how undervalued the industry is. Just from this initial research, I can already see there's going to be a lot of money being made investing in these companies, and I'm not going to be one of those people who misses out. And in this video, I found at least 10 companies that I think need far deeper research. Now, I've been doing this for a while now, and this is incredible to find this many companies, and it's a big reason why I wanted to make these insurance videos. So if you like making money, well, here it is. Here is the opportunity to make some money. Now, please tell me your thoughts on the brief analysis that I've done into all of these different companies. And if you like my work, well, subscribe to my channel to follow me along, and I will see you in the next video.